In 2020, an ETF was quietly launched that flipped the traditional investing world upside down. It wasn't your average dividend fund or index tracker. This ETF didn't care about safe blue-chip stocks or conservative income strategies. It didn't play by the usual rules. In fact, many financial advisors and analysts called it irresponsible, dangerous, or even borderline illegal. But here's what they didn't expect: it crushed the market. It generated income like no other ETF before, and for a certain type of investor, it's a potential millionaire maker, if you understand how to use it. In this video, we're diving into the ETF Wall Street doesn't want you to know about, the one that bends the rules, rewrites the strategy book, and might just fast-track your portfolio to 7 figures. Let's get started. Okay, first, let's clear something up. When we say illegal, we're not talking about something that's actually criminal. This ETF is SEC approved, listed on the market, and fully regulated. But in the eyes of traditional investing purists, it feels illegal. Why? Because it intentionally trades options every single month on some of the riskiest assets in the market. It does what most long-term investors are told never to do: chase yield, cap upside, and double down during volatility. This ETF is the antithesis of the Boglehead philosophy. It's not about slow and steady compounding, it's about monthly cash. Big, juicy, market-beating cash. And that ETF is Tesla, the YieldMax TSLA Option Income Strategy ETF. Launched in 2023, TSLA is part of a new wave of ETFs created by YieldMax. TSLA is a single-stock ETF. It only tracks one underlying asset, Tesla Inc. But instead of simply buying and holding Tesla stock, TSLI uses an aggressive income strategy called a synthetic covered call. It sells call options on Tesla every month and distributes the premium as income to shareholders. That's right. This ETF is engineered to squeeze monthly income out of one of the most volatile stocks in the world. In fact, in its first year, TSLE paid a jaw-dropping 75% dividend yield. Yes, you read that right, 75%. Even if the share price does nothing, the income alone would double your money in about 16 months. Too good to be true? Let's keep digging. To understand TSLI, you need to understand what it's built to do and what it's not built to do. TSLE does not own Tesla stock directly. Instead, it uses a synthetic strategy via options and swaps to replicate Tesla exposure. Then, it sells call options on Tesla at or near the money every single month. The premiums collected from selling those calls, sometimes worth 6 to 8% of the ETF's value each month, are distributed directly to shareholders. If Tesla soars, the ETF's upside is capped. You don't capture the moonshot gains. If Tesla crashes, the ETF drops, but those juicy option premiums help offset some of the losses. If Tesla trades sideways, that's the sweet spot. You collect massive income while the price stays range-bound. This isn't a long-term growth ETF, it's a monthly income machine. And yes, it's risky, but managed right, it can be incredibly powerful. TSLE is not for everyone, let's be clear. If you're 25 and building wealth for the next 40 years, this is not your core holding. If you're retired and looking for dependable, low-risk income, again, probably not your best bet. But if you're an aggressive investor with a high-risk tolerance, if you want to create monthly cash flow from a small portion of your portfolio, if you believe in Tesla's long-term future but want to turn volatility into income, TSLE could be the ETF you've been waiting for. A $10,000 investment in TSLI during its launch would have returned over $7,500 in dividends within a year. That's a real-world result. And with Tesla's continued price swings, the opportunity to repeat or even beat that return is real. Now let's talk millionaire math. To turn TSLI into a $1 million portfolio, you need a game plan. Here's a sample roadmap. Start with a $100,000 allocation to TSLI, which is 10% of a $1 million portfolio, or your entire investment if you're bold. Reinvest all monthly dividends. At a 60% annual yield, your investment could double every 18 to 20 months. Using the rule of 72, at 60% yield, your money doubles every approximately 1.2 years. In 5 years, you're at $1 million. Now this assumes yields stay high. They may drop in volatile markets. TSLE maintains stability, meaning Tesla's price doesn't collapse, and no massive regulatory changes. It's not guaranteed, but it's mathematically possible and people are already doing it. Just scroll through Reddit forums, income YouTube channels, or Twitter finance accounts. Investors are stacking monthly TSLE payouts like clockwork. Some report over $2,000 per month in income from less than $40,000 invested. That's not fiction. It's real cash flow. So what's the catch? There are several. No upside participation. If Tesla doubles in a month, you don't benefit, you've sold away the upside. Capital decay risk. If Tesla trends down long-term, your ETF value may erode, even as income continues. Tax headaches. These monthly payouts are often taxed as short-term gains. Unless held in a tax-advantaged account, your IRS bill could be steep. Liquidity risk. Single-stock ETFs can behave erratically in fast-moving markets. Yield trap. That 70% yield? It can be cut if volatility dries up or if regulators impose new rules. This isn't a buy-and-forget ETF. It's a tactical, high-octane tool for those who actively monitor their positions. You don't have to go all in on TSLE. Many smart investors pair it with safer ETFs to balance risk and income. Here's an example hybrid portfolio. 40% in TSLI for high income, 30% in GPI or GIPQ for smoother yield, 20% in SCHD for dividend growth, and 10% in cash or bonds for defense. This approach still delivers massive income but spreads the risk across multiple strategies. With this setup, your portfolio can generate 20 to 30% blended yield while maintaining some long-term growth. TSLE is part of a new generation of ETFs that blur the line between income investing and options trading. Yield. Max has already released similar ETFs for names like APLY, which focuses on Apple, NVDY for NVIDIA, AMD for AMD, and ORC, which targets Cathie Wood's ARK. These are high-yield, high-volatility vehicles for cash flow enthusiasts. In 2025, we're likely to see even more exotic ETFs with creative options overlays, daily distributions, and dynamic hedging. Wall Street might scoff at them, but for the smart retail investor, these ETFs offer a way to generate income in a world where bonds and savings accounts barely keep up with inflation. TSLI may not be for everyone. It's risky, it's unconventional, and it breaks a lot of the rules we're taught about investing. But that's exactly why it works for a certain type of investor. If you understand the risks, if you're willing to stay informed, if you're looking to generate monthly income that can actually change your life, then TSLI and ETFs like it could be your unfair advantage, maybe even your millionaire shortcut. Like this deep dive? Smash the like button and subscribe for more ETF breakdowns, income strategies, and portfolio building tips. Comment below if you want a custom income plan using TSLE or similar ETFs. Let's build your $1 million game plan together.